Markets look calm, but capital positioning, rate behavior, and defense assets are telling us a different story. Institutions are carrying almost no cash. Japan is quietly stepping back from its own bond market, and gold and silver are moving as if investors are preparing for stress. Price looks stable, but market structure does not, and that's what I want to get into in today's video. So here's the question that actually matters this week. Are we setting up for a liquidity shock that hits risk assets quickly? Or are we still in a phase where excessive positioning keeps absorbing every dip? By the end of today's video, you'll have a simple 3-signal checklist to track over the next 7 days. No hype, no narratives. Just a clean framework you can assess risk while others react to headlines. So let's begin. And let's start with positioning, because positioning tells you how fragile a market really is. Institutional cash levels are sitting near historic lows, around 3% of assets under management. That's the lowest reading we've seen since this data series began in the 1900s. And more importantly, this didn't happen gradually. Cash levels dropped sharply over the last few months. So that tells us something simple. Large investors didn't ease into risk. They didn't move slowly. They rushed back in. And that's our first signal. Institutions are already leaned in. So now let's look at retail. Retail investors have been aggressively buying broad market exposure with repeated billion-dollar inflow days and heavy single stock buying. So you have a scenario where you have professionals low on cash and retail, the 99%, consistently buying pullbacks. This combination can support markets for longer than people expect. But it also creates fragility in the market. When everyone is positioned the same way, it doesn't take much to force a repositioning. It's like the concept of putting all your eggs in one basket. What's the risk there? Well, the risk is that now you're completely invested, and whatever happens to that one basket of your eggs, well, that's all of your holdings. That will have a tremendous impact on you. It's not exactly the right 100% correct analogy, but it paints a picture of what's going on. Which brings us to where real risk usually originates. Most market breaks don't start with headlines. They start with rates. So let's look at the bond market. We see Japan is no longer absorbing pressure. And this is significant because Japan has supplied global liquidity for decades. Right now, the Bank of Japan is stepping back. Its share of the government bond market has fallen to multi-year lows. Bond purchases have slowed materially under quantitative tightening, and at the same time, foreign participation in Japanese government bonds has declined. So the setup is straightforward. The central bank is less active, foreign buyers are less active, and the market has to absorb more supply with less support. When that pressure builds, it doesn't stay contained. It shows up in global yields, tighter financial conditions, weaker risk appetite, and eventually higher beta assets, including crypto. Now, let us layer in what is happening in the US. We see that the Treasury has been buying back its own debt. These buybacks aren't stimulus, they're operational. They're used when market depth and absorption start to matter more. So you have Japan stepping back from support, while the US steps in selectively to keep treasury markets functioning smoothly. That's not a crisis signal. It's a message. Bond markets are becoming more sensitive. And when the foundation tightens, risk assets eventually respond. Now let's look at assets that tend to move before stress becomes obvious. Gold, relative to equities, is pushing into a long-standing resistance zone. That's the type of move you see when capital quietly rotates towards protection, even while stocks indexes still look stable. Leadership shifts usually show up here first. And then there's silver. Silver, we see, has moved sharply in a short period of time, reviving aggressive upside targets across precious metals. And there are two forces at work. One concern around around real yields, geopolitics, and confidence. And the other is momentum. When a trend becomes clean, capital follows. Either way, the takeaway for crypto is the same. When gold and silver accelerate, liquidity conditions and risk perception are changing. Crypto does not operate independently of that environment. And now let's layer in a familiar accelerant. Geopolitical tensions increase weekend risk because liquidity compresses. Fewer participants, wider spreads, more gap risk. That's how calm markets shift quickly. So your question might be, where does Bitcoin sit right now amidst all of this? Well, Bitcoin is range-bound. Support has held in the low 80s, rallies are falling near the short-term holder cost basis in the high 90s, and that level is important because break-even creates supply. When newer holders finally get back to even, many sell. That's why recent rallies stall. This isn't breakdown behavior, it's simply balance. And when Bitcoin is balanced, while macro stress indicators rise, the eventual move tends to be sharper than consensus expects, than everyone expects. And here is one of the cleanest liquidity indicators in crypto, stablecoin dominance. Think of it as on-chain cash. When it falls, capital is moving into risk. And when it rises, capital is defensive. And right now, stablecoin dominance is losing upward momentum, with several indicators pointing lower. That aligns with rotation back into Bitcoin and higher beta assets, as long as the broader structure holds. Looking one layer deeper, we see that realized profit across the Bitcoin network has cooled to levels typical of consolidation phases. Momentum has slowed and volatility compresses. Secondly, long-term holders are distributing supply at elevated levels. This isn't automatically bearish. It reflects older holders passing supply to newer demand. Markets often chop during this transfer. And then thirdly, we have the miners. Miner stress has stabilized after a difficult period. When forced selling eases, one source of structural pressure is removed, even if macro conditions remain challenging. And now here is your 3-signal checklist for the next 7 days. First, rate pressure. Watch global yield spikes and developments tied to Japan. Second, we have defensive leadership. If gold and silver continue leading while equities hold up, pay attention. And third, Bitcoin's range boundaries. Low 80s is support and high 90s is your supply range. Those are the rails. And here is the synthesis. Institutions are already committed. Retail is buying dips. Bond markets are becoming more sensitive. Defensive assets like gold and silver are leading. And geopolitics adds to the gap risk, something we have to watch over the weekend. And this combination, okay, is where markets stop drifting and start repricing. So as we close out, remember to stay plugged in. Keep watching the news, keep tuning into my channel if it helps you, because even though the market is not pumping, okay, or is not highly volatile, it doesn't mean anything is not happening. And it doesn't mean we're not gonna see a huge rally this year, which I am completely convinced we are for many reasons. Many of the reasons I've covered in my last videos in the last month or two, it all adds up and creates a case for why I believe this year, 2026, is going to be an incredibly bullish year. And then most importantly, remember my videos are for educational purposes only. I'm not giving financial advice. I'm simply wanting to provide you a framework to help you stay grounded when markets try to pull you into emotional decisions. I love you guys so much. That's a wrap for this week, and I'll catch you guys here on Monday. Take care.